Hello. I just wanted to come on and say hello. I just got off a really amazing webinar with fellow University of Michigan alum. It was a finance panel, so I was sitting on a panel with certified financial planners, and most financial professionals are not trained on how to manage student loans. I got to have the privilege to serve on the panel, but I got a really interesting question as well as an immediate LinkedIn follow-up that I wanted to address and include on my YouTube channel, which essentially is interest rates are really low. Should I refinance? So I want you to think about this in two ways, okay? Because this individual who was asking is interested in potentially buying a house soon. So if you're in the private sector, like already privatized your loans, already refinanced and took it to the private side, then refinancing to get a lower percentage on your loan can be helpful. However, what this individual was asking was, he has a 15-year loan term. Should he shorten it to 10 and increase the amount he pays every month so he can get out of debt sooner? But he's interested in buying a house, right? So I wanted to have this discussion on how your student loans and decisions around your student loans actually affect your ability to access credit and to borrow and get access to other types of borrowing vehicles like personal loans or mortgages, for example. Your decisions around your student loans affect your credit and your credit worthiness. So one of the huge factors in lending, as well as your credit worthiness, is your debt to income ratio. And that simply means, to try to make the terms understandable, is essentially it means what is the total amount of student loan debt you have in the case of student loans to the amount of annual earnings you have, right? So if you have so much debt as compared to your income, you're viewed as more of a risk because a larger part of your budget has to service your debt, right? So credit policies of mortgage companies, there's very specific rules the government sets so that there's not another subprime mortgage crisis, that if you have too high of a percentage of debt as compared to your income, they can't give you access to as much money if you want to buy a house. So essentially, if you have student loans, there's two ways you can think about it. You're either already on the private market, you can refinance to get a lower rate and therefore lower your payment slightly, so you have this lower debt to income ratio. Or if you're on the public side, right? You're a public servant, you work for a nonprofit hospital system, you work for a school system, a university system, a municipal government, you think about going onto an income-driven plan because that lowers your payment, and mortgage companies view that. It depends on what type of mortgage, right? Certain types of mortgage don't view you, they take like 1% of your loan balance instead of your monthly payment. But if you can reduce your monthly payment by getting onto an income-driven plan, my hair is not cooperating with me today in this video. If you can reduce your payment by getting onto an income-driven repayment plan, and also hopefully filing the Public Service Loan Forgiveness Program if you're a public servant, or if not, and let's say you're on the private side, but you have too much debt as compared to your income, then you could still get onto an income-driven plan. Either way, it reduces your debt to income ratio, which opens up your credit so that you can actually buy a house and afford other lines of credits. So I just wanted to make this video to help people that are coming to pivotal decisions in their life, that they're considering other major financial goals outside of obviously just managing debt, right? Everybody has larger aspirations. So just keep in mind, how does your decisions around your loans impact your credit score? So to sum it up, I'd say, yeah, refinance if you can get a lower rate. Do not shorten the term, because if you shorten the term, it's going to make your payment higher. Therefore, credit companies will view it as you have too much debt, like your current payment is too high as compared to your income. Whereas on an income-driven plan, if you reduce your payment amount based on your income, 10% of your discretionary income, I have an article on what that means if you so want, then you reduce that debt to income ratio, that holy grail of the credit score and of credit policies for mortgages, right? So I wanted to throw this out there. And if you found this informative at all, I'd love to ask you to please hit the thumbs up button and subscribe to our channel right below. And we will have many more pro tips around student loans coming up. And we're just going to do kind of quick discussions on our debt to wealth series, because we understand student loan decisions are not made in isolation. They're made in conjunction to all the other financial decisions people have to make. So we have a free guide below in the description. And so download the free guide. We also are offering webinars right now. You can join our webinar for absolutely free. And yeah, love to update you more. We'll talk soon.